Hi everyone, thank you so much for tuning in for another executive interview. Today we have with us Peter Rossi, the founder and chief investment officer at Amplify Funds Management, a company that is making waves with its innovative fuel and convenience trust. Peter, thanks for joining me.
No problems, Rhythm. Great to be aboard.
Now, Peter, let's dive right in. So, the Fuel and Convenience Trust targets a total return of 12.25% per annum, which is quite attractive in today's market. So, can you break down how this return is actually achieved and what strategies do you employ to meet this target?
Your total return or internal rate of return is sort of basically made up of two elements. It has the distribution return, which is for us is an average of 8.5% per annum, and that's distributed quarterly. So that's your cash flow return, and then you add on top of that the capital gain that occurs. And with our investment, the capital gains basically underpinned by a 3% per annum guaranteed increase in the rent that comes from Chevron. So you add the 8.5% of the distribution return and the capital gain on top of that. And with our forecasts and our target is 12.25% per annum return once for the total term of the trust.
Amazing. That's a comprehensive strategy, Peter. Now, let's address a topic that's on many investors' minds. So, with the growing trend towards electric vehicles, how do you see the fuel and convenience sector evolving, and how is this trust positioned to adapt to these changes?
We've very carefully selected our portfolio, where we've sought to minimise or negate, in some regards, the effect of electric vehicles. So we've chosen either highway sites or industrial refueling stations or very strong rural economies where there's a high demand for fuel. We don't see that with the particular location of our assets that there'll be any impact. We've sought to do some investigations and some research through the Australian Automobile Association, and if you go away from the highly urbanised areas of Brisbane, Sydney, and Melbourne, the statistics show that there's under half a car per thousand of electric vehicles outside the built-up metropolitan areas. So whilst in the metro areas, EVs are emerging. My personal belief is they're heading more towards hybrids, but outside the metropolitan areas, there's less than half a car per thousand of registered EVs in Australia. So it's not a big impact. I think the other change we're seeing in the fuel and convenience sector is the rise of convenience. So I think traditionally it's been about 70% of turnover coming from fuel and about 30% from the shop. And certainly with the moves that some of the groups are making, that proportion is now equalising. And I think the future that we're seeing there is that the food could very well overtake fuel.
Absolutely. Thanks for clarifying that, Peter. Now, you mentioned that the assets are 100% backed by Chevron, which is very intriguing. So, can you tell us how does this relationship actually contribute to the security and stability of the investment?
It's really the cornerstone of our investment. Chevron itself, as the head entity, is the second largest energy business on the planet. So a very, very big organisation. I think $400 billion US market cap. We're dealing with the Australian arm of Chevron, Chevron Downstream. And they are the lessee on all of the sites that we've got. Very, very comfortable with the fact that Chevron, as a massive entity, is backing our leases.
Now, Peter, shifting gears a bit, I'd like to discuss Amplify's investment approach. So, how does Amplify's skin in the game approach, where founders co-invest alongside with other investors, aligned with investor interests?
Yeah, look, it's very important to us that we have skin in the games, that we're investing on equal footing to all the investors that come along with us. The four founders and directors, myself, Andrew Dowling, Peter Honeycomb, and Vanessa Honeycomb, all have contributions in each of the investment. So the decisions that we make for the investors, we are actually making for ourselves as equal investors with all of the other capital that we raise. So it's very important We consider this a co-investment. So we're standing right beside all of the other investors that are in the fund.
Peter, now let's talk about the portfolio itself. So, can you discuss the geographic diversity of this portfolio and how this serves as a risk mitigation strategy?
Yeah, the spread of assets are across geographies and also sectors. So our assets go from Atherton in the north down to Nambour. And in terms of sectors, we've chosen highway sites, which are high volume sites servicing the logistic traffic, the truckies. We've also chosen industrial refueling stations where the industrial traffic is actually filling up before they head on their journeys. And then very strong agricultural towns like Nambour and Atherton. Those diverse businesses all rely very heavily on fuel, so we see it as a real benefit. Equally, the diversity in location we think is also a great de-risking factor, because what we're doing is we're moving away from geographical concentration. And if you took in an Armageddon scenario that Cairns gets hit by a cyclone or it gets hit by a tidal wave, we've still got 6 other assets in our portfolio that continue to pay the returns to investors. So we're just looking at that approach as being a de-risking strategy to make sure that we can get those returns of 8.5% per annum through to the investors quarter after quarter after quarter.
Absolutely, and that's a very smart approach to risk management. So, finally, Peter, looking ahead, what opportunities or challenges do you foresee in the fuel and convenience sector, and how is Amplify preparing for these?
We'll start with challenges because I don't think there are very many. We're really in the essence of this fund, we're really just rent collectors from Chevron. So with their strong covenant and their strong businesses, we don't think there'll be terribly many challenges. They're starting to pivot their business towards the convenience sector as well, and we think that that's where there's some real opportunities. I think the growth in non-fuel sales will be very strong, and as an elastic or a non-discretionary commodity, fuel will not go anywhere. So that's what we see as the real opportunities. Each of the assets that we've chosen have some element of value add. So whether we can sell a block of land here, sell a shed there, put up a fast food, each of those properties have that opportunity. Now, we haven't factored that into our return metrics. They are just opportunities that we will take when they arise. So we think there is certainly some cream to go on the cake, but the 8.5% distribution per annum and the 12.25% internal rate of return rely purely on the cake. We believe there is cream there and that we can add some value to these assets, but our forecasts are based on almost an arithmetic approach to the rent. So we're just collecting Chevron's rent, we're managing the assets, and we pass that straight through to the investors.
Absolutely. Well, thank you, Peter, for sharing your valuable insights with us today. Your innovative approach and strategic planning certainly offer an intriguing opportunity for sophisticated investors that are looking for attractive returns in the commercial property sector. Now, for those watching this interview, if you would like to get in touch with the team at Amplify, please check out the contact information available on the side of the screen or in the description of this video. Once again, thank you, Peter, and we wish you all the luck with your venture moving forward.
Yeah, wonderful. Thanks for having me.